Well, good morning, good afternoon, and a very warm welcome to today's webinar on geopolitics and its macroeconomic implications for the insurance industry. My name is Anthony Kennaway, and I'm the Head of Group Public Affairs here at Swiss Re. What may once have appeared as a temporary disruptions to the global geopolitical picture are now looking much more like structural shifts with implications for trade, capital flows, and energy, not least. And so to help us make sense of the current situation and to discuss that with us today, I'm delighted to be joined by two distinguished experts. First of all, James Crabtree, who is a distinguished visiting fellow on the Council on Foreign Relations and a leading commentator on politics, geopolitics and international affairs. James, a very warm welcome to you. And of course, our very own Dr. Jérôme Haegeli, who is the Group Chief Economist. He's the Managing Editor of the Sigma and also the head of the Swiss Re Institute. Jérôme, good morning.
Great to be back. Thank you.
Good to see you. The realization seems to have dawned that we're going through a cyclical rather than a secular rather than a cyclical change. From your perspective, what are the really big moving pieces in that, and what are we underestimating?
I mean, the two big changes are the rise of China and the changing role of the United States. And I think at the moment, it's the changing role of the United States that is most prominent. This is an America that behaves very differently. It's much more unilateral. It's less cooperative with allies. And you've seen that in the way that it has dealt with Iran, the way right at the moment today in the G7, you have a fissure between the US and its traditional partners in Europe. You see it in the way that President Trump is willing to praise autocratic leaders like Vladimir Putin and President Xi. This is a very different United States from the one that we've been used to, and that has ramifications all throughout the global order.
Yeah. Very good. And what about the things that are moving and that we're misunderstanding? What are the things you think that people are missing right now?
I mean, I think you can see the importance of weaponization of dependencies. You see in a number of these different crises that we've had, the willingness of the larger powers in the world to use the architecture of globalization, the economic and trade links we've built up over the last 20 or 30 years for their own advantage. So no longer are these things sources of security, they're new sources of risk. And that might be the closure of the Straits of Hormuz, it might be other international choke points, it might be excessive reliance on AI tools or semiconductors. But I think one of the things that people are waking up to is that the unprecedented world we live in is one in which there are still interconnections of the kind that we've not seen historically, but that these are being weaponized in new ways that create a whole new range of risks.
And you mentioned also, thank you, and you also mentioned the sort of the different relationships that are beginning to exist now between Xi and Putin and those sorts of things. How do you see the dynamics of that developing over time, and what should we make of that?
I think one of the big changes that you see in the world is that most countries are seeking to diversify away from a reliance on the two big powers in the world, and particularly the United States, as in the way that it has been behaving is leading Europeans, the Middle East after Iran, traditional US allies in Northeast Asia, to try and seek new partners and new ways of achieving autonomy, because they're worried on the one hand about the impact of China and the fact that China is willing to put pressure on them, as you saw last year with the rare earths restrictions, but they're also increasingly worried about the United States, a United States that can take away AI models or that is willing to put pressure on former partners, whether that's in Greenland or in other places. So I think that's in chancelleries and prime ministers' offices, people are thinking about how do I develop sovereign autonomy? How do I manage in this world without having to rely excessively on other countries that could become sources of risk?
Right. And famously, Mark Carney, in his speech in Davos, spoke about the rupture that was taking place and sort of spoke to the secular changes that are going on. And he also encouraged middle powers really to move forward and to embrace one another and collaborate together. Are we seeing much of that, do you think?
Yeah, I mean, I think you see a lot of it. I mean, I think the challenge that you face is it's quite difficult to replace what you've lost with an uncomplicated China and a traditional United States. So if you look at what Europe has been trying to do with India, for instance, Prime Minister Modi today is meeting not just with President Trump, but with a range of other world leaders at the G7 meeting not far from here over the border in France. India's been a big source. India's trying to diversify because its relationship with the United States has become a little bit tricky, but lots of countries are trying to do deals with India as well. So I think you see a lot of this geopolitical diversification going on. The challenge is that it is hard to use that to the degree that it replaces what has been lost.
Yeah. And then in the Middle East, obviously, significant news coming out this week. Hard to prepare a webinar, I must say, on during this process to try and, as the situation is so dynamic. How do you see this playing out, the current situation, and what do you think the next steps are from in the Middle East and Iran and so on?
Well, I think we haven't seen the deal text yet, so there's a lot of speculation about what might be in it, but there are a couple of things that are clear. The first is that the United States has struggled to achieve, and Israel as well, have struggled to achieve their objectives. This is a minimal deal. It reopens the straits, but it doesn't deal with most of the complex issues that have been a problem for the last 20 years. It doesn't deal with nuclear weapons or Iranian enrichment. Crucially, it also doesn't really solve the problem of the fact that Iran maintains control over the Straits of Hormuz, and that is now a fact of international relations. So previously we were worried about Iran having a nuclear weapon, and that would be their source of deterrence to keep the US and Israel at bay. Now Iran has in its back pocket the fact that it can close the Straits of Hormuz if things go against it. So I think in the medium term, both Iran and the United States wanted this war finished for their own reasons, and that's why they've signed this deal. But it isn't going to be a stable situation. And the fact that Iran would be able to close the Straits of Hormuz, not at will, but it has that option, shows the fraying of the international order and creates a quite alarming precedent for other seaways as well. If you have a situation in which countries are having to pay the Iranians to keep the straits open, then that creates a precedent for other choke points around the world.
Yes, actually, and that is there are a number now, if I'm not mistaken. Yep. Very good. And of course, so sort of the lens of the world has been really focused on the Middle East during this crisis. What are the other actors at a geopolitical level to be making of this, and how has it changed the calculus, for example, for Russia, for China, and other countries?
I mean, I think China will view this as broadly positive, that this is finished, and the lessons that China takes out of this are fundamentally viewed through its lens of the relationship with the United States. That's what matters towards China. That's why they've put so much stead in creating this new diplomatic process with President Trump, where they met recently. President Xi will go to Washington in September. And so they will look at this and say, we think what we understood about the United States is true, that the US is very powerful militarily, that it is able to intervene and it is unpredictable, but that actually it's not a perfect international actor. It is struggling with weapons supplies. It hasn't been able to bend the Iranians to its will, and it is weak in some other areas, for instance in areas like the energy transition, where China is moving very quickly to build renewables and wean itself off supplies of unreliable Middle Eastern oil. So I think China will look at this, be happy that the war is over. That will be helpful for domestic stability, and will continue with its long-term plan to build up internal strength and reduce its dependency. For Russia, this isn't great. I mean, the oil price has gone down below 80 today, and the lower the oil price is, the worse that is for Putin's war economy. Puts him in a slightly weaker position with respect to Iran, but in a sense he has many other problems to worry about there as well.
Yeah, and lower oil prices, though, a boon for perhaps countries like India. I know you're a specialist on India as well. What are they to make of the current situation?
This has been a much more difficult situation for India than China, and not just India, but any of the emerging energy-dependent nations in Asia. So it's a relief, but it's been a difficult situation, and I think it suggests that there are likely to be greater periods of economic fragility for vulnerable emerging markets, and India has been one of those where they've had to introduce a range of emergency measures to manage energy supplies, and it will refocus the minds of leaders around the world to try and follow China's path in a rapid transition to renewables, and to remove dependence on gas and imports of oil, because in the end that is a source of strategic vulnerability in a more fragile world.
Yeah, that's great, and we'll get on to the macroeconomics piece of that with Jérôme in just a second. Looking at it, a lot of countries seem less interested really in taking sides in this, but actually sort of maximising their own position. Who are the main players in that, and what are the positions they're trying to maximise? I'm trying to think of countries like Turkey and so on, but what are the game seems to have changed a little bit from a bipolar world into everyone now just actually trying to sort of maximise their own positions. How do you see that? Do you recognise that, and do you acknowledge? What are the implications of that if that is the case?
And I think you see in the diplomacy around Iran the importance of a rising array of middle powers, and in a sense the relatively declining importance of traditional powers like Europe or Japan. So the negotiations for this was substantially carried out by Qatar and Pakistan. And you see a range of other middle powers who are trying to work out how they develop their own sovereign capability. So Turkey would be one, the Gulf countries, Saudi Arabia, all have a much more independent foreign policy than they used to, and all are trying to diversify and develop new foreign policy relationships. So for instance, during the shooting war, you saw the Gulf countries reach out to Ukraine, for instance, because of Ukraine's advantage in drone technology. And so one of the big changes that's happened over the last year is the new understanding of the importance of drones as a new form of military technology. And so Saudi Arabia, the GCC, were reaching out to Ukraine and asking Ukraine to send them drone supplies to manage Iran. And that's an example of the new middle power world that we're moving into.
And there's a really fascinating piece there, isn't there, about technology and actually the implications it has for geopolitics. I know that the tide of the war in Ukraine has flowed back and forth between advantage for Russia and advantage for Ukraine. It seems to be heading in Ukraine's direction at the moment, possibly as a result of the technological systems and Maven, I think it is, that they've managed to use. Can you just talk a bit about that? Do you think we're towards an end game here, or are we still in just the tide flowing back and forth?
I think we don't know yet. So President Zelensky and President Trump met yesterday on the sidelines of the G7. President Trump seems very uninterested in pivoting from his purported triumph in Iran to now trying to fix Ukraine. The sense is that he's got a bit bored of this conflict and wants it over, but isn't willing to put his own shoulder to the wheel. Yes, militarily, Ukraine is doing better. It's turned the table partly because of improvements in drone warfare and medium-range strike capabilities. But in the end, somebody has to force President Putin to come to the table and accept a ceasefire. I mean, a ceasefire is the most likely option, not a large deal which deals with all of the various grievances of the war, a little bit like what's just happened in Iran. We need to have a minimal ceasefire, and the question is, given President Putin still has hopes of a broader victory, who will force him to do that if he doesn't want to? It's clear that Ukraine wants that. Will the Americans use their leverage to push the Russians to accept a ceasefire and then have negotiations? If not, then there is no particular, the fighting will continue.
Yeah. Okay, James, that's great. And then the last thing I wanted to sort of pull into this overview of geopolitics as it stands right now is technology, and of course AI is all over the headlines as well, and potentially a game changer from a geopolitical situation as well, isn't it?
Absolutely, and you've seen a really interesting example of the theme of weaponization and interdependence over the last few days because of the withdrawal of Anthropic's Fable model. The United States last Friday sent out an order, an export control order, limiting or stopping access by any foreign country or foreign citizen, and that shows the extent to which these technologies are vital new tools of statecraft. The United States is both trying to emerge as the leading AI superpower with respect to China, but it is also going to control access to these tools in a way that risks dependencies amongst everyone else, particularly here for those of us in Europe, where most countries and companies are going to initially use American tools, but if they discover that these can be withdrawn arbitrarily by the United States, then they have to understand that that also creates new risks as well.
Yeah, and I believe that France has made a move in that direction just over the last 24 hours. James, huge thanks to you. Very quick canter through the sort of the geopolitical landscape. With that sort of context, Jérôme, a remarkable macroeconomic, geoeconomic situation which you look at us for Swiss Re. Tell us a bit about that.
No, absolutely. Extremely remarkable environment we are in. And James mentioned the weaponization of dependencies. Let me build on that and also translate it into what does it mean for us? What does it mean for the global macro economy? And also what should we look at? We don't know the path forward in terms of how the situation will develop, obviously not. However, it's these times of uncertainties, there's also a lot of things that we do know, and these are the structural changes and regime shifts. And in that context, I would also like to highlight these, while just talking about the risks, I would also want to touch on the great opportunities out there. But first of all, I want to phrase the outlook that we are in, and there's a lot of movements happening. It's definitely a regime shift. There's no question about that, and it's definitely an unstable equilibrium where we are in. I would argue, if there's one thing that is really key, these are the structural factors to remember. These are what defines how the regime shifts that's actually going to be impacting the economy and also us as insurance players and actors in the environment. It's F, it's R, and it's 10. Let me tell you what it is. F, it stands for the fragmentation out there. And this is nothing new. We see it within economies, we see it across economies. Think about fragmentation with K-shaped economy or K-shaped recovery in the US, with the haves and not haves. This is leading to populism. This has led to Brexit in a larger context is also part of geopolitical risk, this disintegration or disintegration risk that we had seen in the EU. Besides fragmentation, and fragmentation in trade, fragmentation in terms of also how the shock is impacting the various regions in the world, and I will come to that very, very shortly. I think it's also really important that we're very much in a fiscal world. Yes, the central bank world doesn't go away. Central banks remain here. They remain the biggest actors in town when it comes to markets. My worry out there is that actually they will work for the fiscal agents and that we're also going to have a blow up in terms of fiscal deficits. Let me speak about that later on. However, it's also a fragile environment, and that's why I think it's super important to think about scenarios. Now, one thing that it isn't, I'm pretty much convinced as well, if you look at the data in the US, labor market is doing fine, growth is actually pretty strong. It's the fourth supply shock in 6 years we have been weathering. And I totally agree with what you mentioned before, James. US is in a state of exceptionalism, meaning R, the letter R, it doesn't stand for recession, no way. You would need to see the Strait of Hormuz, the passage of the Hormuz being completely closed until the year end. It's not that it's not impossible, but it looks to be more unlikely. Actually, if anything, the US is actually reflating again. And there's good case to be made. Tonight, we're going to hear from the new Fed Governor Walsh what he's going to do with the policy rate. He won't be cutting. Everybody expected at the beginning of the year he will be cutting. He won't. So he will be standing on a pause. There could be good arguments actually will be hiking, but he won't be hiking either. R also stands for the regime shifts that we have to think about. But 10, I think it's really simple. It's 10 million barrels per day which is being lost, right? Because this is what is not going to the Strait of Hormuz. So I would strongly argue, yes, what is happening in the Strait of Hormuz is super important. And I would go so far and say what is happening in the Strait of Hormuz is more important, I will show you shortly, actually what happened on the trade front, on the trade tensions with the US. 10 million barrels per day being lost, that's about the amount of the EU, right, in terms of consumption. So this is lifeblood of our economies, lifeblood of jobs, and you need more oil in AI revolution, and we are definitely probably even just at the start of the AI and the CapEx evolution. FR10, fragmentation, it's fiscal, it's fragile, it's not a recession, it's a regime shift, and it's also the level of risk in terms of scale from 0 to 10. We are closer to 10. But look at those. It's also the World Cup, which has started recently, right? And I would predict, I'm biased here, watch out Mbappé. He is French, FR for France, and he has the number 10 behind. He will be the top scorer. So far, he's not. Messi is ahead, but I'm pretty convinced that actually he will be. And if there's one way you want to remember it, maybe think about Mbappé, and then you get back to the FR10. But more seriously, in terms of numbers, I want to show you numbers. How do we translate the big picture into numbers? And this is what you see in terms of the numbers. Without going into details, you see here our central forecast and you see the scenario ranges. We need to show both because the central forecast, that's not the baseline. The baseline is always, and you from the insurance industry will appreciate that. The baseline is always a distribution of risk. That's why we show the central forecast together with the distribution of the risk, which is here in the brackets. The takeaway is oil supply shock, it's stagflationary, and stagflation means more inflation and lower growth. That's number one. Number two, in terms of how actually we changed the forecast, you see it here. And the takeaway here is there was a stronger effect, and it's playing out also like this. There is a stronger effect in terms of lifting inflation higher than dampening growth. And what's more, there's also a stronger regional effect. And oil shock, it's really bad. It's really bad for Europe, bad for Asia, less so for China because it's more energy independent. But definitely bad for Europe, which is flirting closer to a recession. I think in the bigger picture, it's also very clear that AI is a very positive cross current. AI is positive for growth in the US, it's positive for CapEx. It has been positive for the rally in equity markets that we are seeing. We are at the record level, let's not forget. Despite all these risks that we are talking about, markets are actually positive. And there's also good reasons they are positive. Because the AI revolution, it's for real. It's money being spent, it's investments, it's data centers, and it's also leading to wealth, which can be consumed. That's the positive side of the story. Obviously, the more challenging side of the story is that there's a lot of dependency in terms of markets. What if the AI boom in terms of earnings expectations would slow down? Then also the Magnificent Seven, which constitute about 1/3 of the S&P market cap, that relationship would weaken. But what's more, the relationship also of AI driving consumption in the US would also weaken. But we don't see why it should weaken. I would say it would only weaken if inflation goes through the roof and then interest rates go to the roof, which brings me back to the Strait of Hormuz. So Strait of Hormuz, tail risk being lower, it's positive. I think the big takeaway is also bigger picture and regime shift. We are in for a global race. Absolutely. It's a global race on AI, a global race on natural resources, a global race on digital resources, global race on rare earth, global race on fintech. And that's why I would totally agree with what you said. US exceptionalism is here. Europe is very, very, very behind. Upside is that if they join, there's potential. And obviously, China is in that global race. But I think these factors, these global race factors, this is industrial policy, and this will not go away. I will come back to that at the end, because I think that's also where a lot of our opportunities are in our businesses. Very briefly, scenarios. Let me just outline very briefly the scenarios for the Strait of Hormuz. You see here 3 scenarios. We are in the scenario 1. We do expect the partial transit recovery during the summer. It won't be a full recovery. It's very unlikely, right? Yes, part of the deal, actually it's not a deal, it's a memorandum of understanding to negotiate and to have a ceasefire for 60 days. The stock of uranium needs to be cleared. How long the ambition of Iran not to be a nuclear power, that is also part of the negotiations. Is it 50 years, is it 20 years? And then also the freedom of navigation. Will the Strait of Hormuz really be open? A lot of ifs. And then also, you need to have the ships first moving out of the Strait of Hormuz before new ships can come. In any case, the best case scenario is not a scenario where you're going to see actually energy flowing back to 100%. We would see energy flowing back to about 50% to pre-crisis. That's manageable, but it still means the pressure is on oil prices and pressure is on inflation. And then if I look at both, if I look at market prices, what you mentioned, James, before, Brent prices below $80 per barrel, there's so much good news. Yes, it's good that the tail of scenario 3, that is going to be completely closed, that is probably now decreased the likelihood, but still it's still more risk to the upside, and the execution risk is here. And I think also the execution risk, what happens after the midterms, which I will talk very, very briefly. Strait of Hormuz, we talked about. James talked about AI, I totally agree. And here you see actually the key factors and risk factors I think we need to think about, and also that we at Swiss Re very closely look at. And it might be the case that each one of these risk factors that we list here that are manageable by themselves, might be, but what is really new, I think, is the interconnection also of the risk, the accumulation of the risk. And I would also agree, what tops my very list is what is on top of this list, which is AI. AI because of the dependencies, but then AI also because of the fragmentation. Fact that non-US companies have zero access to Mythos in terms of testing it, and that Mythos as a frontier LLM is so powerful, is a worry. And I think with AI, even if we were to have access, European companies or non-US companies, I think we need to be ready, and we need to buckle up because of the risk of cyber attacks on critical infrastructure, with AI lowering the costs to do it and increasing the likelihood to do it. I think it's just something to be waiting to happen. And I think that is something which would be extremely powerful. Let me still touch on 3 themes, and then I will stop. Then we hopefully go to the Q&A. But on the 3 themes, and it also relates to the FR10, the theme number 1 is politics. Geopolitics is politics. Geopolitics, it can be domestic politics. In any case, we all know now a global race that is being played means there's industrial policies at play, and industrial policies become economic policies. So a key question is, what happens after the midterms? Well, after the midterms, we will see. But if consensus is correct that the Congress will be split, then I do not believe that the macro impact, first of all, would change very much. No, but but at the same time, I would think the market volatility surrounding the policies and the policy reaction functions, I still think this would remain very, very high. And to me, what we need to watch is interest rates. We need to expect that interest rates remain higher for longer. And it would be a very sign to me if 10-year rates would go up 4.5% or to 5%, then it's much more difficult to finance the fiscal deficit or the oil leverage in the system. And then the independence of the central bank also becomes much more challenging. So I think the midterms we need to watch, because there's probably a policy set of framework also in terms of the current administration willingness to have memorandum of understandings and ceasefire agreements pre-midterms and then also post-midterms. But we will see. Second point, and this is exactly, I think, touching on the topic, showing with a graph with what James said. The weaponization of dependencies or weaponization of capital markets. First of all, remember I said the 10 stands for the lost global output, and the lost global output by the Strait of Hormuz. I also said it's more important than actually what happened in the US with the tariffs or the trade tensions. And I think you see this pretty well if you look at the left-hand graph. You see the US effective tariff rate. Yes, it has gone through the roof. Historically unprecedented since the 1930s. It went up from 2%, below 3%, to almost 17%, is now somewhere 13 to 12%. Correct. That's the unilateral effective tariff rate of the US to its trading partners. But then what counts for the global economy is how do other actors react? And that's why we look in terms of our analysis when we make our forecasts to support the clients, but also to support the process, the internal process. If you look at the global effective tariff rate, that's the dotted line, you see not very much has happened. It's flat. And why is that the case? That's the case because, yes, you have trade tensions, but you didn't have a trade war. You didn't have tit for tat. Mm-hmm. And I think what's happening on the trade front, goods, it's not pretty, but it's not a game changer at all. What would be a game changer is if the weaponization moves over from trade to goods sector and would go even so far to go over to capital markets. And maybe technology, what James alluded to, AI, access to AI technologies, fragmenting it, that might be the first step. Second step is restricting FDI investments. Third step might be doing extraterritorial moves, be it in collateral requirement or then also access to financial markets. And that is something which will need to be watched in case this multipolar world will continue. It will continue, but would become more extreme. Now, I will end in terms of bringing it back home to the team, right, in terms of dependencies, but also in terms of the new regime. Past is globalization, low inflation, that's over. It's not bad also that this is over, actually, because it means the low and negative interest rate is over. And what's happening, and look at the graph on the left-hand side, we are in for the biggest capital expenditures move in our lifetime outside war periods. The global infrastructure investment needs, this is an estimate by one consulting company. There are other estimates that are pretty similar. It's $100 trillion. And this is not just physical infrastructure, it's also digital, it's also social infrastructure, so it's huge. You can map it, when we try to map it to the countries, and it's not just that the gap, the needed, that one that is not the gap, which means the needs which is not already being financed, that's not the highest in the US. It's high in Brazil, it's high in South Africa. It's also high in Europe. So these are the opportunities out there. And I think we as insurance players, you as a client, we play a huge role in this reindustrialization, because we need to analyze the risk, we need to bundle the risk, and we need to provide underwriting services. So yes, coming back to the question, are we a new world order? Absolutely yes. Multipolar world is not going away. It's going to be different. Higher inflation, more pressure points, more volatility. But if you go from a just in time to just in case supply chain, that takes time and that takes investment. And I think this is also positive in terms of growth and also jobs. Now you saw a lot of data, you saw a lot of analysis. Looking forward to lots of questions. In case you wanted to look at some of the research, you wanted to look it up, please also, you can access here with the QR code. There's a Swiss Re Sigma client portal where you see a lot of what you have been shown here, the data, the raw data to work with, but then also don't hesitate to come back to us. Absolutely. But back to you.
Jérôme,
thank you.
James, thank you both very much indeed. I think a very rich picture out there, and I'm delighted to see that we've already got some questions in. This is a chance now for you, the audience, to ask your questions of Jérôme and James. So let's go in for the top here. Jérôme, I think this is one for you, but and I think you've touched on this already. But how much of today's inflation risk is about energy markets, and how much reflects the wider fragmentation?
Mm-hmm. I think currently and presently it is about the energy market, right? The energy market risk, because energy, it flows one-to-one into headline CPI, not in core CPI. but the relationship 1-to-1, gas prices up 50%, oil prices up 50%, so 1-to-1 relationship that you see, but oil prices and gas prices coming down, meaning it's not static. The more important risk, however, I do believe is the fragmentation risk.
Right.
Yeah.
Right. Very good, thank you. James, one for you here. The US security umbrella among the Gulf states, is that sort of trust in that umbrella? Is that still extant? How do you see that situation right now?
I think it's a paradoxical situation that the Gulf states and Israel both integrated militarily with the United States to an unprecedented degree during this campaign. I mean, it was really a joint offensive campaign between the US and Israel and a joint defensive campaign between the US and the Gulf states. On the other hand, the US is a less unreliable, more complicated actor, and so the Gulf states, like everybody else, are seeking avenues for diversification. And so they, as we mentioned, making partnerships with Ukraine, with the Europeans, with South Korea. The problem that they have is there isn't really a better option out there. It isn't as if they can suddenly turn to China or Russia or another set of powers to replace what the US has lost. So I think the US is, although there is now quite a lot of tension, particularly between the US and Israel, and a lot of grumbling about the US in the GCC and within Saudi Arabia, I think they're stuck with each other.
Yeah, okay, thank you. Jérôme, I think fiscal deficits, and you were talking about the infrastructure investment that needs to be done, huge amount of investment requirement for the infrastructure that you're talking about. Where's the financing going to come from, and what about the bond market stress that was mentioned in the question just now?
I think it's a great question, and the financing of all these infrastructure needs, it will need to come from the private sector. It can't come from the government. Government, as you said, is stretched already. You have fiscal deficits almost 2 digits. It's 6 to 7% in the US. The debt overhang, public debt relative to GDP, is higher than 100%. And since COVID and since global financial crisis, trajectory is not good. And the higher the interest rates go, the more difficult it is to finance. Meaning, we need to find a way to open up capital markets and also deepen capital markets and also create more tradable asset classes. It's not impossible, it's very much possible. Infrastructure debt, if you think about the aspirations out there and also the ambitions of Australia in the G20, infrastructure has been for a long time a priority topic at the G20. The topic of tradable asset class remains very at the front, and I wouldn't be surprised at all if it doesn't come back, and I see it in many of the international meetings that it does come back. So the money needs to come from long-term investors, yes, insurance companies, pension funds, mutual funds, but I think that's exactly where our role plays in, because we can de-risk. And if you can de-risk projects and assets coming on stream, you also make it more bankable and tradable. So I think, again, this is needs to come from the private sector. Insurance companies play outsized role here, actually, to de-risk, analyze, and then bring it up to the market.
Absolutely, and even in the adaptation phase.
Absolutely.
As well. Yeah. Well, thank you. And a couple of questions now, James. I think I'm going to direct this one to you about AI models and access to AI models. How much do you think geopolitical shifts underway and sort of vulnerability to AI models getting shut off is going to play a role in the geopolitics of the near and medium term?
I think it's going to be big. One of the things we haven't talked about this week, in Brussels, there's a meeting of the European Council where European nations are trying to work out how they de-risk economically from China. But I think in the same way, you're going to see companies and countries trying to work out the risks of excessive dependence on either American or Chinese AI models. And that doesn't mean not using them. In the end, the best technology in the world is American or Chinese, and most countries and companies are going to use it in some respect. But that they're going to have to seek a diversity of supply so that in particular niches or in particular areas, they're not wholly reliant on one of these two countries, because the risk is that at some point in the future, there will be some geopolitical geopolitical crisis or other, and access to these tools might get cut off, just in the same way as was true with rare earths, or just as the way it might be true with battery technology for electronic vehicles. And that is the world that Jérôme was talking about, a world of the weaponization of integrated supply chains. And so I think excessive reliance on one single national supplier is going to be a risk. It'll be a risk that some decide that they want to take, but it's a risk that I think sensible countries and companies will want to manage more carefully.
Yeah.
I totally agree with what you say, James. The risk is really big. It's AI, I would argue, remains, the number one opportunity, but then also the flip side, it's a real risk because of this fragmentation of access and technologies, which is why I would think we would also, if Europe can provide more regulation, that would be a good thing. We have, for banking, we have banking regulation, we have a Basel Committee.
Yeah.
I wouldn't be surprised that we're going to have a world where you're going to have AI committees, like a Basel Committee, which is, maybe it's a dreamland world, right? Where you have some rules and principles, but again, it's not far-fetched because that's where the systemic risks are, not in the balance sheet of the banks.
Yeah, and a rare call for more regulation rather than
always the right regulation is important.
The right regulation, level playing field.
First step is always the right regulation, and one that is transparent, but also level playing field.
Yeah.
But if you have a world where Europe has one set of regulation and the US has a different set, it's difficult. Then the weaponization is the risk that companies need to think about, and that's very, very suboptimal.
And I'd like to come back to the Draghi report, James, maybe with you in just a second, and where we're going, where we're getting to with that. But the sort of paradoxical, the AI thing, is because it's such a capable tool, and we're making great use of it here at Swiss Re, for example. But it is also going to create a dependence that exposes the vulnerability generally to the wider world in terms of who gets to use it and so on.
Yeah, no, absolutely. Yeah.
Draghi report, competitiveness. I hear the Commission's meeting much more regularly, is trying to get through regulation quicker. Do we see much out of the EU on competitiveness, James?
I think it's a slow process. There's a consensus about the need for change, and Europe's problems in the world are fundamentally problems of competitiveness. The reason why it struggles in the face of Chinese exports is partly to do with unfair subsidies on the Chinese side, but it's also partly because these Chinese products, particularly in areas like EVs, are much cheaper and in many ways much better than the ones that Europe can produce, and that they're done at a much greater scale using underlying technologies to which Europe doesn't have access. So Europe has a hard road ahead in order to regain competitiveness, and there are some signs that it's moving down that road, but I think not quickly enough.
Yeah, very good. Okay, good. Jérôme, from your side, I know that you have been going through scenarios a lot, working very well in these circumstances. How often are you changing those scenarios? And tell us a bit more about the scenario process and what you're doing with clients.
Well, it's very simple. Facts change. Not necessarily do I need to change the scenario. Hopefully I don't, and most of the times I don't need to, but where we are within the scenarios, that is what is changing. Which is why I think in the scenario process, what is really, really important is that you have clarity in terms of your assumptions. You lay them out very transparently, not just from a narrative perspective, but then also triggers, and then also oil price. And that's why you saw, for example, for the Strait of Hormuz, for each of the scenarios, we laid out for each month, and obviously these are projections. What's more important is maybe the quarterly profile of oil prices. We lay that out, and then we can also see, is the market more likely in that scenario, or are we totally off? And that just helps us to guide through the impact as we go through a world of heightened risk. But actually the good news is, if I look back over the last 5 to 6, 7, 8 years, the big scenarios that we use as also own your risk self-assessment, right? The tail risk scenarios, 5 to 10% scenarios. The scenario choices. We always had the stagflation scenario choice. Always had a recession scenario. So that doesn't change.
Yeah. Good, thank you. Then, and the last question from our audience, James, one for you. What's the most important geopolitical shift underway in Asia that business leaders continue to underestimate?
I mean, I think I'd highlight Jérôme had a nice phrase about the shift from a just-in-time to a just-in-case world. I think that's exactly the shift that business leaders need to understand and to prepare for. The challenge is that comes with trade-offs. A just-in-time world is more profitable than a just-in-case world. And so typically what you see is businesses react when there's a crisis and they worry about it, and then there's a dip and things return to a period of relative stability, and people forget about this. So I think you've seen over the last few years, through COVID, through periods of Ukraine, now Iran, that you have these moments of higher salience of the need to diversify, to de-risk, to understand the risk profiles. But then the risk is that it sort of ebbs away until the next crisis comes along. And so I think a combination of government doing more at the European level, at the national level, but also businesses understanding that this is a very fundamental shift, that the world that we live in now is very different from the world of 10 or 20 years ago, and that if you have to accept slightly lower profits to mitigate against risks in the future, then that's something that you have to explain to your shareholders and stakeholders.
Brilliant. Well, there we land quite clearly on the answer to the question for our webinar, which is it's a secular shift. Thank you both very much indeed for your inputs on that. It's a fascinating conversation, and I'm sure we could go on for quite a bit longer. And thanks to you also, the audience, for joining us today. We'll post a recording of this online if you want to rewatch it or send it on to other people. Other than that, thank you very much indeed for joining us today. Thanks to both of our speakers, and we look forward to seeing you soon. Bye for now.